Hello and welcome back to Business Matters at the Hindu with me, K. Bharat Kumar. Last month, Finance Minister Nirmala Sitharaman urged captains of Indian industry to expand their investments in manufacturing. She asked them why they were hesitant and likened Indian industry to Lord Hanuman from the Ramayana, implying that the industry needed reminding of its own strength. She said, "This is the time for India and we cannot afford to miss the bus now." Why did she urge them thus? In the hope of revitalising investments in the country, the government had in September 2019 cut tax rates for domestic companies from 30% to 22%. For new manufacturing units set up after October 1st, 2019, the tax rate was set at 15%, assuming of course that these companies did not avail of any other tax source. Then came the production-linked incentive schemes for various sectors and so on. But even then, the pace of investments was not as high as the government would have hoped to have seen, and that is likely the reason for the minister's comment. In this discussion, let's look at two aspects. One, macroeconomic indicators that show a certain sluggishness in investments in manufacturing over the recent past. And two, why there is a glimmer of hope that there is a rebound in the offing. So how dim is our economic scenario now? Niranjan Rajyadaksha, an economist and CEO and senior fellow at Artha Global, says that Indian private sector investment has been weak for almost a decade now. And if we look at the drivers of economic growth in India currently, there are some amber lights flashing. He points out that the export story, which was a success for India for the year ended March 2022, will be under threat now because of a looming global recession. And the Indian government's ability to support domestic demand would also not be that high because it has to gradually bring down the fiscal deficit. He also says that the K-shaped recovery, which is what we saw when we emerged out of the pandemic, meant that private consumption has been concentrated only in some parts of the income pyramid. Now for some macroeconomic numbers. Generally, when a country goes through a period of growth, it's traditional to look at a certain figure and say how we've grown from a year earlier. But when we've been through something as sudden and life-changing as the pandemic, it is also useful to look at a performance quarter to quarter or month to month to show how well or poorly we've been recovering from such a downturn. For the first quarter of this fiscal year, that is for the quarter ended June, gross fixed capital formation or GFCF at 2011-12 prices rose 9.6%. This is compared with the 11.6 lakh crore in Q1 of FY20, that is pre-pandemic, to what is now 12.77 lakh crore. This is in the context of overall GDP growth of 2.8% to 36.85 lakh crore, again compared with Q1 of FY20. Manufacturing GVA or gross value added rose 6.5% in Q1 of FY23 compared with Q1 of FY20. Private final consumption expenditure, which is an important pillar for our economy and into which metric all of our retail purchases, whether you and I buy soaps, TVs, washing machines, all of these get captured by that metric. This grew 26% from a year earlier, but compared to the Jan-March quarter, this contracted 2.4% or by a significant rupees 54,000 crore. Not just that, but even government spending, and again gross fixed capital formation, if we look at quarter on quarter growth, there was no growth. There was a contraction of 10.4% and 6.8% respectively. Let's come past June into August and September and look at a couple of indicators starting from April, which is the start of the fiscal year. Let's look at IIP or the Index of Industrial Production and a private sector survey called the S&P Purchasing Managers Index for Manufacturing. In both of these, you'll notice that the growth has been in fits and starts. There has been growth, but there has been stalling. 2 steps forward, 1 step backward. That's the sense that we get. Have a look at these graphs. The IIP numbers are released by the government with a 1-month lag. And so we have figures from April to August. If you see the growth rates in percentage from a year earlier, you see growth, but it has gone from 7.1 to 19.6 and then back down to 12.3, 2.2 and then 0.8%. The S&P Purchasing Managers Index for Manufacturing is a proxy for business conditions as well as a leading indicator for the IIP that we've just seen. That has seen expansion every month, but we noticed that in May and June, the numbers suffered a slowing expansion as did August and September compared to the immediately preceding month. Just to set the context, PMI is based on a survey of 400 managers who respond to queries on new orders, Output, employment, suppliers delivery, and stock. Figures above 50 show expansion. So clearly, the PMI for manufacturing has no doubt shown a rise every month, but the expansion has not been consistent. In an article in The Hindu earlier this month, Mr. Pulapre Balakrishnan, who teaches at Ashoka University, argued that public spending or government spending is a precursor to private investments, but that public sector spending would need to be sustained for about half a decade at least in order to kindle enthusiasm for private sector investments. Why? Because government spending triggers demand, it sets up aggregate demand, and that is a signal for the private sector to say, hey, I'm interested. He says that this cycle of public sector spending should have started a few years ago. But now that the government has announced its intent to aggressively spend on infrastructure for this fiscal 22-23, he says it has to look at two aspects as top priorities. One is to be able to choose the right projects. He says investments must be directed into productivity enhancing infrastructure. And the second is to be able to control inflation. He says high inflation can derail the best designed public sector programs. He says a step up in agricultural produce is needed to rein in food inflation. Earlier in this discussion, we saw that government spending helps set the pace for private sector spending. And when do private companies invest? Invest when they see demand. Where are we at when it comes to consumption demand? The Hindu data team's recent deep dive into consumption demand gives us a sense of increasing activity. The Google Mobility Index, for instance, shows an increasing trend now of people visiting workplaces, grocery stores and pharmacies, and places of recreation than over the past 2 years. As we can see from the other chart, data from the Federation of Automobile Dealers Associations shows that retail sales of two-wheelers, passenger vehicles, tractors, and commercial vehicles have seen an upswing, and sales figures have either matched or exceeded those seen in 2019, that is prior to the pandemic. The Center for Monitoring Indian Economy, or the CMIE's Consumer Sentiment Index, is still below the levels seen pre-pandemic, but is far higher than seen 12 to 18 months ago. We've looked at numbers from the government and private sector surveys and so on. What does the RBI have to say about demand? In its monetary policy report issued on September 30th, the Reserve Bank says the data for Q2, that is the quarter ended September, shows that aggregate demand remained buoyant and has been supported by ongoing recovery in private consumption and investment demand. The report also noted, importantly, that seasonally adjusted capacity utilization rose to 74.3% in Q1, the highest in the last 3 years. It also said that manufacturing firms recorded a sequential uptick in new orders, while infrastructure firms displayed optimism on the overall business situation, turnover, and employment in Q2. Why did we refer to capacity utilization as important? Think of yourself as a manufacturer. If your factory can put out 100 units at any given point in time, and the demand in the market is only for 30 units, you're not going to add capacity. You still have 70 more to go, right? And then the demand goes up from 30 to 60, you're still comfortable. But when it reaches a certain saturation, that's when you say, you know what, let me be prepared. Looks like the demand is going up. Let me expand capacity. And that's when investments into manufacturing capacity happen. Dr. Rajit Yaksha of Artha Global, whom we quoted earlier in this conversation, says that India is probably only a short distance away from reaching capacity utilization levels at which investment cycles pick up. He says that utilization levels were very low at 67-68% during the pandemic, but have now come back to the 74-75% level. He says the general thumb rule is for utilization levels to reach 78-80%, and that's when the private investment cycle truly picks up again. He says unless there's a major event that sets the entire global economy back, it is likely that India would see a pickup in investment cycles in a few months. An online survey conducted in August on consumption outlook by UBS Evidence Lab India with 1,500 consumers showed that nearly 3/4 of respondents said that they had stable or increasing income levels, and this compared with only 54% a year earlier. Household savings intentions remain high, with 56% respondents saying that they would like to increase their household savings by the year end. Results also suggest a high purchase intention for cars and two-wheelers. All these forecasts, combined with the rising capacity utilization, are probably what hold the key for a long overdue private capital expenditure cycle kicking off soon. Come November 30th, and the government will tell us how the economy fared for the quarter ended September. Let's wait and watch how that pans out. Till the next episode of Business Matters, it's goodbye from us and have a lovely week ahead.